Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark can be easily reached. He is over in Glastonbury with Financial Resources Group. That's right here in Connecticut. You can find him online, www.frplan.com. F as in Frank, rplan.com. Write this phone number down. If you got to call him right now, you can do it. I'd rather have you wait, though, till the end of the show. Okay? As long as you give him a call. And let me tell you, if you already have a financial advisor, meet with Mark. He's the wealth of information that he's going to provide for you and how he's going to help you is really limitless. 860-657-8380. Again, 860-657-8380. He's got this Roth Blueprint with up to 97% of increase in wealth. There's no jumping any tax brackets. There's no decline in principal balance on conversion, and there's no out-of-pocket cost. You want this free, right? He's giving it to you for nothing.
Well, yeah. Well, it's actually, the work that we do for people that come to these seminars, it's literally a $2,500 value. So if you come to the seminar and you make your appointment that night, we'll waive the $2,500 assessment fee, and you won't have to pay that. But we're actually going to be talking about the asset map, and also something that we call the Roth Blueprint, okay, and then also something called the asset map and financial planning. So I'm going to make that show about, today's show is going to be more about financial planning, less about the market. If we do run out of time with the financial planning, I want to go back to possibly Gary talking about the Bitcoin relation to the Japanese yen carry trade and some of those other things. But that's okay. Let's talk about financial planning, because I think this is what people are worried about. And, I get the question all the time, can I retire? And, that all depends, Gary. It all depends on what your lifestyle is. And so today, the first thing, what really inspired the show is we get this research called Market Desk Research. It's the best research I've ever seen. And we pay a lot of money for it. But they came out with a chart of the month. And they came out, remember that song Radiohead by Radiohead called Creep?
Oh, yeah.
I'm a creep. Yeah, I'm not very good over the radio.
Not everybody knows that song.
Yeah, so this isn't the same kind of creep. This is called the lifestyle creep. So why don't we get into it, Gary? And I'll tell you what actually happens and why people are able to save more than others. And then, it's the same thing on the back end. If you're able to save a lot on the front end and you build up a nice nest egg, you're going to be fine when you retire because you have a budget. But if you're one of these, you're a spender. And, if you're a spender, you're going to be a spender in your retirement, too.
So lifestyle creep, that's where you started with. Tell us, what does that even mean?
Okay, Gary, I know. It's kind of a weird... It actually was new to me. I never heard about this. And then I started thinking about this. And I said, oh, gee, when you start making a little more money, you feel a little bit more emboldened and you're tempted to buy more expensive things. So, True. Absolutely. So let's talk about that for a minute, especially as it relates to retirement planning, because you get a good salary, you try and save, and you think you're just going to be fine putting money away every week. But one of the most important things I try and help people understand is that financial progress should not be measured by your paycheck alone. So, we've seen people who make $300,000-$400,000 a year, but we're like, okay, we're waiting for the 401k to come out. We're like, well, where's the beef, And they're like way behind. Yeah. And they'll always have a legitimate reason. But then there's other folks that are just like, man, we just spend too much, So the decisions you make during your peak earning years are just as important as the size of your salary. So, Gary, a lot of high earners are actually underprepared for retirement, not because they didn't make enough money, because of something we call the lifestyle creep. And let me explain what that is the tendency for everybody's spending to rise alongside of their income. So imagine this, if your income goes up, you save more and not spend more, you're going to have a shorter time horizon to retirement than someone who says, oh, I'm going to make more and I'm going to sell my, 2,000 square foot house in Newington and I'm going to buy a 5,000 square foot house in Rocky Hill. You don't realize what just happened to your insurance went up. Your taxes went up.
Your utilities went up. Everything
your utility went up. Your lawn care, your maintenance. Oh, now I have a third garage, so I need to buy a car for that. Let's go maybe buy a fun thing, a Jeep, a boat, whatever. So, you have to live your life. But I'm just saying, we want to talk about, maybe they take a bigger vacation, they spend more day to day. But they don't think about it because they have the money to do it. So the money disappears into lifestyle upgrades rather than building long-term wealth and security. And the tricky part, it all feels natural. You worked hard, you deserve it, which is true. But if every dollar of every raise goes to lifestyle, you're actually making your future retirement harder to sustain because your cost of living keeps going up too.
So then what do you think is the smarter approach? I mean, what do you tell your clients?
Well, we loved using a simple illustration for this. Imagine two 35-year-olds. Both are earning $80,000 a year. Figure a cop and a nurse, right? That's about right.
Okay.
All right. And both are, getting 3% raises every year, and each are starting by contributing 10% of their salary to their retirement. Now, the only difference is what they do with their salaries. The first person, let's call them the lifestyle individual, keeps their contribution fixed at the initial $8,000 a year and spends every raise on lifestyle upgrades. So they're going to well, I'm still saving. Let me spend on a lifestyle upgrade, the fun stuff. The second person, the saver, who sets aside 25% of every raise and enjoys the rest. So basically on a $2,000 raise, they save an extra $500 a year. That's all they have to do. Not even half the raise.
And then what happens over time?
Well, the results are dramatic, Gary. This is going to freak you out. Over 30 years, both earning the same salary, the lifestyle individual contributed about $250,000 to retirement. Wow. Which grew to nearly $1.2 million. The saver contributed about $630,000. Just dead. We're talking about a lot of extra money, Gary.
Oh, incredible.
Yeah. And then that grew to nearly $2.2 million, almost $1 million more. And that's not magic. They're making the same money, Gary. It's just that one decided to take a bigger part of their raise or their increase and put that into their retirement while the other one spent it. And the other one was still saving, right? But think about that. And so that's the compounding effect of working over decades. Saving just a portion of each raise creates a snowball that gets bigger and bigger over time. Now, that's the difference between the people who can go on vacation. Wow. That's the difference between people that have that house in Florida. That's the difference between the people who...
So
there's a big difference. The people who aren't struggling in their retirement.
Mark, this is insane. That's $1 million difference just from... how you handled your raise? That's incredible. And that's not like the saver was actually depriving themselves. They still got to enjoy most of their raise, right?
Yeah, all they did was set aside 25% of every raise, and they still enjoyed the rest. 25% of the raise. So if you got a $2,000 raise, Gary, that means all they did was extra $500.
Look, Mark, I know...
Now, $500, you can't even, you might Ruth Chris dinner, right? Right? You feed a family of 6, maybe. You're lucky to get out with 5 for $500. So think about that for a minute. It's an extra $500 of the raise, and they still enjoyed 75% of the other raise. So think about just using that simple formula, what the big difference, if you're listening and you have kids and that are just starting to earn some real money, think about that for a minute, too. This is the difference, by the way, between you having to help your kids because they haven't saved enough of money. And this is a great lesson for them.
That's a great point. Listen, one of the things that sets your practice apart is how you help clients get organized and see the full picture of their finances. And you use something called, you said this earlier, an asset map software. What is that? Tell me, what is this all about? Tell me more about it.
This really is a software that we've adapted in the practice. It's a very simple way to visualize your finances, your income, your cash flow, your investments, your pensions, your Social Security, and then your assets, your Roths, your IRAs, your brokerage accounts, your savings accounts, your CDs. Maybe you have a note payable from one of the children you borrowed money from, whatever the source is. We can put it all in one easy report called an asset map. And if you go to our account, www.frplan.com on our website, and you scroll down just a little bit, you'll see a video talking about the asset map and how it gets people organized. Now, to everybody's credit out there, you've all come to me with this elaborate spreadsheet that is wonderful. And the fact that you have the spreadsheet is great. But when I convert that spreadsheet to an asset map, it's night and day. Because those are just numbers in labels on an Excel spreadsheet. When you see, it looks like an organization chart, Gary. You ever look at, let's say, the Board of Education, and so, okay, here's the chairman of the board, and then the vice president, and then you see these are the board members.
Any spreadsheet.
Everyone's like in a little box, right? So it's got that thing, and then, okay, these are the subordinates. This is exactly what it does, and it shows you, okay, this is the spouse's money, this is your money. And then what we're able to do, once we get this stuff constrained, we can say, oh, you're 120% overfunded for your retirement, so you can actually retire now, and then we come up with a rate that you're able to pull your money out, which I'm very good at, by the way. We don't adhere to the 4% rule. That's been debunked. I'm talking 5.5%. In fact, even more without you having to change a single investment, which is another strategy. But most people don't need to take out that much. But anyway, so yeah, the asset map is a really powerful and simple tool to organize your brain.
And it's not really just about investments, right? I mean, it's the whole picture.
Now, this is financial planning because it talks more about that. It's not just talking about assets and investments, income sources, insurance policies, debts. But for a lot of clients, the first time they've ever seen anything laid out together in such a clear and organized way, it becomes a real anchor for our financial planning conversations. So I do the hard work up front, Gary. It's no different like anything in life. You go to school, okay, then you maybe get a job, and then maybe you go get an MBA, and the company pays for it. Maybe you get 2 MBAs, the company pays for it. But now you've got that done. By the time you're 30, you've got all your degrees, and you can just move up that corporate ladder a lot quicker. And that's exactly what we do when it comes to the planning, because I just had a client call me and says, can I retire? And I'm looking at, $2.9 million plus a couple pensions and Social Security timing. They're too young. One is 60, so he's not taking Social Security for a while. I was like, hey, even if we don't touch this to 67, you're good. You're good. And this is how we're going to do it. And I barely even had to tap a big chunk of their retirement. So that money can grow. And then around that, by the way, once we have the asset map, then I can say, this is all you need to live. Let's take the extra. Oh, and by the way, your next tax bracket, take the difference and do a Roth conversion. So there's so many cool things we can do.
You also use
everybody's different.
You call what something that you call like what a financial fire drill? I love that term. I don't even know what it means. I just love the term. Yeah. How do you use it for that? What is that?
Well, these are the what ifs that happen in life. It's like essentially asking what happens if something goes wrong.
Oh,
because life doesn't always go according to plan.
Right.
And let's face it, the best time to think about those things is before they happen. You want to do this when you're in sound mind. You want to do it when you're in sound health. You don't want to deal. You don't want to deal with these decisions in the middle of a crisis. Because think about it: if you get sick or you're in chronic pain, is your brain thinking clearly?
No, of course not.
Do you want to be dealing with this stuff then, or do you want to be prepared before? And can you prepare after the fact, or does it have to be done in advance? So we bring this up. Now, we're not here to crack the whip on anybody and tell them what to do. We are here to bring it up, and we ask them, how are you going to pay for that? And a couple examples of that would be, obviously, long-term care is the big boogeyman in the room. And what happens if you or your spouse eventually need assisted living or in-home care? These costs can be staggering, Gary. And I'm going to be doing a presentation on long-term care. And there's so many different ways now in products that you can use to pay for long-term care. And then there's also legal avenues that you can take. But I think you do both. You take the legal avenues, you protect yourself legally, but also you protect yourself financially. And there's plenty of different ways to do it. You shouldn't just say, plan for Medicaid and then, burn through all my money. I don't think that's the right plan. So if you have the right plan in place, you can do it.
Do you think people overlook it? Is it often overlooked until it's too late?
No, I you know what? You have, just like the savers we talked about, that extra $500 a month being another $1 million in their retirement. Those are the same people that do look into this. They research it, they figure out what their budget for it is, and they actually go, and you're never going to pay 100% of your long-term care bill. You may never need it. So you want to make sure that you can get some of that money back if you pass away, or it can go to your spouse, or the benefits can transfer to a spouse. Or you can grow your money, and at the same time, if you need it for long-term care, then it would pay up to a certain amount for long-term care. So there's so many different options out there.
What about home?
It's not just long-term care either.
What about your home insurance? Or that might seem more straightforward, but
I talk about that in the 21-point checklist. Okay. So let's talk about home insurance. What about disability, Gary? What happens when I'm in my peak earnings years? I'm 54, and something happened to me where I had a nervous breakdown. And I couldn't work anymore. right?
Right. That's
Yeah.
what would you do?
Right, because of the stress or something happens or you get in a bad accident. So you have to have that. So you have to look at disability insurance too if you're still a breadwinner, especially for those high-earning pre-retirees that we like to meet with often. They're very tough to catch, but those high-earning pre-retirees. I really only deal with retirees, but once in a while we'll get pre-retirees who have a lot of money and have high income and need tax advice. But and we want to talk about things like we want to talk about disability. We want to talk about your home insurance. We want to make sure that policy is going to cover the damages that have been incurred, because a lot of times, let's face it, if you don't pay attention to that policy and you're not reviewing it once a year with your advisor, and they have to, you call your advisor, say, I need $30,000 under my account because I'm fighting the insurance company and I need to call the contractor. Oh, great. So now you have to sell stuff. You have to pay tax on it. Think about the nightmare that causes, all because your advisor didn't work with you to make sure your policy got reviewed with your insurance
What
agent.
about loss of life?
Yeah, loss of life's a big one. But Gary, what kind of advisor would I be if I wasn't checking on those things?
Listen. You've already established yourself. You really are you're the guru of Connecticut.
And the other thing is the loss of life, Gary, is life insurance. There's been tons of research on widows, the average age of a widow in the United States. And what's happening is older men, let's face it, Bill Belichick is dating a 21-year-old. There's the trend there. Now, I'm not saying that's the norm, but what happens typically in a second relationship normally, okay, I don't know. I don't have the stats on this. But what's happened is women are marrying older men. So what happens is they become widowed earlier before they can get their Social Security, before they can get the benefits. And then sometimes if it's a second marriage, they're not entitled to certain things unless they were with him for at least 10 years. But what happens is they're becoming widowed, and then this guy's life insurance policy lapsed at 69, and he's with a 45-year-old woman. Well, all of a sudden, she's out of luck, right?
Yeah.
So, it depends on what your situation is, especially but if you have children with that woman in a second marriage, that's very common now. So we have to be aware of that as well. And, and planning multi-tier type of planning for
Folks,
sure.
you are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is the president and CEO of Financial Resources Group out of Glastonbury. You can find him online at frplan.com and at 860-657-8380. And one last thing, if you want something that's complimentary, listen to this. It's the Roth Blueprint. He's offering this up to 97% increase in wealth, no jumping tax brackets, no decline in principal balance on conversions, and no out-of-pocket costs, okay? All this Roth Blueprint conversion free of charge with our friend Mark Papa over at Financial Resources Group. Mark, ultimately the goal of all of this is what? It's to make sure that people don't run out of money, right?
Well, don't run out of money, but also don't get caught off guard with some of these things. This is what the asset map will illustrate to you. It'll say if there's a disability, you don't have any insurance. Okay, now you're going to have to start spending your retirement money or money that you have set aside to pay your bills versus getting $10,000 a month for 10 years. What would you rather have? Right?
Yeah.
Or even short-term disability for that matter. Now, I know Connecticut has FMLA for certain things. I've seen people, women on maternity leave get the FMLA, but they didn't have the short-term disability to cover them because they weren't even aware that they can get that. So that's something you can pay out of pocket or maybe through your company, but they may not offer that. So then now, you're eating into your savings, because no one talked to you about it. So those are the things that we like to do. The asset map will illustrate what your liability is, what the potential is, and if you have the funding for it or not. Say underfunded, overfunded. It creates a red flag. It creates a talking point for us to then turn around. And I don't even sell disability insurance, by the way. I actually do that through a third party. I actually would refer you to somebody that's all they do is disability. So I'm not even going to benefit from it. So my point is you will benefit from it as a client of ours if we see that that's a necessity. For sure. So that's what the asset map does. It'll figure that out, long-term care, home insurance. We want to make sure that nothing's going to jump out of the weeds and bite you. And the more we do that, the more we drill that into our clients, the less likely those problematic things will be able to come up.
Do you want to talk about Bitcoin quickly?
Yeah, I can definitely talk about that. It's
gone down.
It's been a very frustrating trade for a lot of people.
Yeah, I'd say.
And it's kind of stuck in the mud. It doesn't want to move. I want to bring something up that we haven't been talking about very much, and it needs to be talked about more and more, is the Japanese carry trade. And this is when Japanese interest rates were next to zero, Gary. A hedge fund or a sophisticated investor could borrow money in yen at zero or next to zero and buy U.S. equities, buy Bitcoin, buy speculative assets. And now what's happened is the Japanese have been working on getting their interest rates higher. They're raising rates. So it's really important to understand this because it's one of those behind-the-scenes mechanisms that can, cause sudden and violent moves in the market that seem to come out of nowhere. And that's one of the areas is actually been the Japanese, yen carry trade, where, again, near zero borrowing rates for hedge funds and big institutions. They borrowed, though, Gary, enormous sums of money in Japanese yen at almost no cost, then turned around and invested that money in higher yielding assets elsewhere in the world, U.S. stocks, U.S. treasuries, emerging market bonds, in Bitcoin. Now, the profit was the difference between what they paid to borrow in Japan at almost nothing and then what they earned on their investments here. And that's what they call the carry trade. So that kind of just reiterates what it is. So the catch is the yen, how this whole trade works beautifully, as long as the yen stays weak and Japanese interest rates stay near zero, everything's great. But the Bank of Japan started raising interest rates, and something that the market hadn't seen from them in decades. All right, in decades. You may want to go back. Remember the Japanese real estate boom? They were buying up everything. Japan was taking over the world.
New York.
One of the coolest bullet points on that was, the Rockefellers are so smart. They built Rockefeller Center in the Depression because they knew that the labor was cheap and people needed work. And so that's when they built Rock Center. They sold it at the peak of the real estate market to the Japanese, at the peak, for huge amounts of money, and then bought it back for pennies on the dollar after.
Oh, is that right?
Yeah. Oh. Which is great, which is why you got to love America. Let's face it, you're not going to fool the Rockefellers, right? So I thought that was a great story. I love going back to the 80s and talking about some of those cautionary tales. But, the yen is strengthened sharply, and this means that if you borrow in yen and invest in dollar-denominated assets, your debt just got more expensive. So that's the carrying cost, right? The carry trade. So now it's costing you more money to borrow to invest. So all these carry trade players basically had to unwind. You get something that's called the margin call, right? And a margin call means, hey, we want our money back. You're taking on too much risk. We're calling your loans. You borrowed too much. There's too much risk in the market. They don't want systematic defaults. They don't want institutions blowing up. So they're going to call your loan. That means you need to liquidate assets to cover that loan. Take your profits. And that's exactly what happened. So they had to sell their investments to pay back their yen loans. And they had to do it very quickly. And that created a cascading sell-off that had nothing to do with U.S. economic fundamentals. It was all market. It was a purely function of the Japanese currency and interest rates becoming unwound all at once, so very, very quickly. And that's no different when the Federal Reserve raised interest rates here. Look what happened to stocks.
Yeah.
Right? Yeah, the S&P was down 20, NASDAQ down 30, 30-year Treasury was down 30. So that's what happens when rates go up. So it wasn't. It was kind of ugly. And so that's basically that story there, Gary. And I mean, I can give you some statistics, but the Japanese stock market dropped like 12% in a single day, the Nikkei. And that was in the summer of August 2024. So we've got to be very, very careful what we do. And we're not doing yen carry trades for our clients. So we do have a little bit of Japanese exposure.
If someone has a financial advisor right now and they've been and they're okay with them, they're happy, but they don't know what they don't know. Maybe they don't stay in touch, or maybe they're listening to you going, wow, I could get a lot more from you, but I've already been with this other person for, I don't know, a few years, and they're not bad, but how would you convert them over to be a client of yours?
Well, that's a great question, Gary. So that's what the full checklist review does. Let's take a look at your situation. Let's take a look and see if you're truly diversified. Let's see if you're not paying unnecessary taxes. Let's see if you're not paying those unnecessary fees. And again, I ran into a client at a very, very big firm. His turnover costs, remember I talked about turnover costs?
Right.
$25,000 annually, Gary. $25K a year. And that was being generous. So I didn't want him to have a heart attack, but $25,000 a year. And the advisor didn't know a thing about it, wasn't showing him, wasn't telling him about it. I also found out that same firm had a bunch of mutual funds in his portfolio. Probably about 50% of the portfolio had funds that were paying money to the broker-dealer in order to be on their platform, what's called the research list. So that's why he got those funds, because they can obviously, they say that, they tried to make up this nonsense that's actually costing less to the investor. But the truth of the matter is it's actually probably costing more in the long run. Because you can get funds that don't have that turnover and funds that they're not paying kickbacks to the dealer. So someone's getting paid extra to recommend those funds versus the funds that don't have those kickbacks.
They need to sit down with you and spend a little bit of time.
Yes, I'd appreciate that.
All right. You got a disclaimer really quick?
Yeah. Financial Resources Group, LLC, is a registered investment advisor here in the state of Connecticut. Please do not, this is for informational purpose only. The views and opinions expressed here are mine personally, not of the firm's. And also, before making any investment decisions, understand that there's risk, and understand that you should consult if it's something you don't understand, especially consult a licensed financial professional that can give you that expert advice before you make any investment decisions.
Are you a licensed investment professional?
Of course I am.
There you go.
Yes, Series 65, and the firm is RAA, so we're fiduciary, so we're both bound legally and ethically to always put your best interest first.
All right.
Which is how we've been doing business for a long time, but we're on the hook for that. So someone can tell you that, and then we're going to find those conflicts.
You got to make sure that
we'll find those conflicts of interest when we do your 21-point checklist and what it's costing you.
And I want to talk about that. You can get the checklist. You can get the Roth Blueprint absolutely free. Your Roth Blueprint checklist up to 97% increase in wealth. There's no jumping any tax brackets, no decline in principal balance on conversion, and no out-of-pocket costs. So important. Financial Resources Group out of Glastonbury, Connecticut. You can find them online at www.f as in Frank, frplan.com, frplan.com, and 860-657-8380. You can call this number right now, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.